Okay, mining stocks are going through what I call the twofold formula. They're completing it. And the thing is, this is the single most profitable pattern I know of, period, when it comes to making money in the financial markets and buying individual stocks. And I got to show it to you. Okay, the twofold formula consists of two simple things. The first is a simple chart pattern. We'll take a look at it in a second. The second thing are some specific fundamental metrics, and we'll go over those too. First, the technical pattern. I call it the stair-step pattern. It's very simple. It's a stock, a market, an ETF, a sector. In this case, we're looking at GDX, the gold stock ETF, and for disclosure purposes, I have a position in it. But what happens is this goes down for a very long period of time, what you're looking at, and then you have a tremendous rally off of a low of 50, 80, even 100% or higher, and then a successful consolidation period that leads to another breakout. Now, what happens during the consolidation period, we just saw it in GDX, is people have seen this huge rally, it is huge, and they say, well, this is so overbought, it's got to pull back. Or I don't believe it, and it's going to crash. I just don't believe it. So they sit there, they watch it, and then it succeeds in holding the gains for 4 to 8 weeks and then breaks out. And what typically happens is the next breakout leads to another big rally, similar in time, similar in duration to the one that led to the consolidation period. What that means is an incredible entry point in the right stocks, because you have stocks that you can buy that have tremendous upside potential and a low risk entry point, because you can theoretically, if you wanted to, put stop loss orders below the consolidation range. And the right stocks go totally crazy. So here's one example. Here's KGC. KGC was below $1.50 in January. It soared to over $3. It more than doubled, and it consolidated for 4 weeks, over 4 weeks, broke out again, and it's already gone from $3 to $4.50. A tremendous surge. These are the type of percentage gains that the twofold formula can create. Now, right now, as I do this video, many people no one's talking about this on CNBC, really, on the internet, really, not on trading boards, so forth, because most people in the United States are still obsessed, still mesmerized by the United States stock market, trying to buy Facebook, trying to buy Apple, hoping it's going to make a new 52-week high, hoping it's going to get there. But they're really trying to do things with lots of downside risk and little potential gain, because they're not playing with a twofold formula. They're just chasing things randomly. They don't even know about the twofold formula, but here it is. And it's appearing in mining stocks. Again, the most profitable trading pattern I know of, period. In all the years I've been doing this, if you look below this video or on the sidebar, you can see a link to my book, Strategic Stock Trading. That book talks about this pattern. It shows previous historical examples of this pattern that I've used, so you can help understand it. So grab that if you haven't read it. Let's talk about the fundamental metric, though, that goes along with this chart pattern and works for the very best of the best stocks in a sector that you're looking at. And that's looking for stocks that have high growth earnings potential and low valuations. We're not looking at the PE ratio. We're looking at something called the PEG ratio, to price to earnings growth ratio. What this means is, let's step back and think. People talk about fundamentals all the time. They say they're a fundamental investor. If you turn on your CNBC television box, you'll see people talk about, I like this stock because it has good fundamentals. What do they mean by that? Usually they'll say, oh, it's got good sales growth. I like the product. I like the gizmo, or something like that. But nothing ever really specific, nothing that you could actually say, I'm going to write on a napkin that this is an actual investment thing that I can put down in numbers of the real strategy that I can write down. The PEG ratio is such a strategy because it doesn't use muddled thinking. It's using the best of all fundamental worlds, high earnings growth, plus the low valuations. Most earnings growth chasers don't look at valuations at all. Most value investors don't necessarily look for high earnings growth. We do both. A PEG ratio historically of 1 is fair valued. 0.5 or below is cheap. And that's how John Templeton picked out his stocks. If you've ever read the book One Up on Wall Street, that entire book is really based on this. It tells you all these stories, but this is the real strategy used using numbers. So we apply that to stocks to find the very best. However, there is a drawback to this strategy, this chart pattern, this combination of fundamental and technical things. Yes, it is the single best way I know of to make money picking out stocks in the financial markets or trades. The problem with the strategy, though, is it only comes at the start of a new bull market. So this right here is called stage analysis. It's what I use to understand where we are in a stock market cycle. Just use the 200-day moving average. Are you above that? Are you below it? Are you going sideways and chopping around in a topping formation? With gold, gold stocks topped out in 2011. They were in this stage 1 base up until this January when they smashed through it. If you look at this, we're at the very beginning of stage 2. We've had that first initial thrust rally. That pullback was the consolidation period. That is the chart pattern involving the twofold formula. Dozens and dozens and dozens of mining stocks are lined up, actually hundreds if you go look at the Canadian exchanges. But the pattern only shows up in mass at the start of a new bull market, the very first inning. If you are in deep in stage 2, if you're in stage 3, you can't find it. If you're in stage 4, you can't find it. In stage 4, what you see are declining stocks that then have sharp bear market rallies, and people try to chase that with very low optimal results because it's just the worst time to be doing it. Stage 3 is kind of like you're spinning your wheels. You're buying things thinking you're going to make something, and it reverses and smashes you. Very tough times to buy. What I'm showing you is the best chart pattern, but it won't work in the U.S. stock market as a whole. It won't work with Apple. It won't work with Facebook. It won't work with Netflix. It won't work with the fad stocks everyone loves. It won't work with biotech stocks such as VRX, which are deep in stage 4, that people keep trying to guess the bottom of them over and over and over again, getting burned. What I'm showing you is the pattern that works, and it works because it works at the right time, and we're presented with this moment in gold stocks. It's the most wonderful moment to be buying into a sector, and here we are. It's going to continue for several weeks, one by one with stocks. They don't all trade exactly one-on-one in sync every single hour, every single day. Some stocks, such as KGC, have already broken out of their consolidation period patterns. Some of them are still locked in them. Some of them have the high earnings growth metrics of the low PEG ratios. Others don't. So we got to do a research, and we've got a buying window to get into such opportunities. And it's the most exciting time we're really going to see for investing in individual stocks for a very long time. And this window is here, and we're taking advantage of it. If you haven't read my book and you want to learn more about the pattern, get the book. Otherwise, keep your eyes tuned to your email inbox, because I'm be sending you more updates, more videos, more information, because this is the moment.